Behind some of the world's most recognizable brands and game-changing innovations, there's often a hidden force at work. It's an industry that operates largely out of the public eye, yet wields enormous influence in the business world. We're talking about private equity funds, and it's reshaping the business landscape in ways you might not even realize. Hi everyone, welcome to the channel. Today we're exploring private equity funds. Understanding private equity is crucial, whether you're an aspiring investor, a business owner, or simply curious about the forces shaping our economy. So let's dive in and demystify this complex but fascinating corner of the financial world. At its core, a private equity fund is a pool of capital raised from wealthy individuals and institutional investors used to invest in or acquire companies. But that simple definition barely scratches the surface of what private equity funds are and how they operate. To truly understand private equity, we need to break it down piece by piece. And let's start with the basics. The private in private equity refers to the fact that these funds invest in private companies or take public companies private. Equity means they're buying ownership stakes in these companies, and fund indicates that it's a pooled investment vehicle combining money from multiple investors. Now let's look at the key players in a private equity fund. The private equity firm. This is the company that creates and manages the fund. Think of names like Blackstone, KKR, or the Carlyle Group. These firms employ teams of investment professionals who source deals, conduct due diligence, and manage the fund's investments. LPs, limited partners. These are the investors who provide the capital for the fund. They're typically institutional investors like pension funds, endowments, insurance companies, and high net worth individuals. LPs commit to investing a certain amount of money which the fund can call as needed for investments. GPs, general partners. These are the managers of the fund, usually senior executives at the private equity firm. They make the investment decisions and manage the portfolio companies. General partners also invest some of their own money in the fund to align their interests with the limited partners. So how does a private equity fund actually work? Let's walk through the life cycle of a typical fund. Step 1, fundraising. The life of a private equity fund begins with fundraising. The private equity firm raises capital from investors, and during this phase, the general partners will outline their investment strategy, target returns, track records, team credentials, and the industries or companies they plan to invest in to the potential limited partners. They'll also specify the fund's terms, including management fees and how profits will be shared. This phase can take anywhere from a few months to even over a year. Investment period. Once the fund closes, it enters the investment period, typically 4 to 6 years. Now, during this time, the fund identifies companies to invest in or acquire. When it finds a suitable target, it calls the necessary capital from its LPs. Portfolio management. After acquiring or investing in a company, the real work begins. Unlike passive investors, private equity firms take an active role in managing and improving their portfolio companies. The fund works to increase the value of the company after acquiring it. Now, this might involve bringing in new management, maybe streamlining operations, expanding into new markets, or making add-on acquisitions. This phase usually lasts 3 to 7 years per investment. Now, this is where private equity firms really earn their money. Their expertise in operational improvements, financial engineering, and strategic planning can dramatically transform businesses. The exit. Finally, the fund sells its investments, hopefully at a profit. And this can happen through various methods. Selling to another company, known as trade sale, selling to another private equity fund, secondary buyout, or taking the company public through an IPO. Distribution. Profits from these exits are distributed back to the limited partners after the private equity firm takes its cut. More on that later. Now, the whole cycle typically lasts around 10 years, after which the fund is then liquidated. Many private equity firms run multiple funds simultaneously, each at different stages of this cycle. Now, if you're wondering how private equity funds make money, well, there are two main ways. The first of which is management fees. Private equity firms typically charge an annual management fee of about 2% of the committed capital. This fee covers the firm's expenses, operating expenses, and salaries. Carried interest. This is the private equity firm's share of the profits, usually 20% of returns above a certain threshold, often 8%. This incentivizes the firm to generate strong returns for its investors. This fee structure is often referred to as 2 and 20, and it's a key reason why successful private equity professionals can earn astronomical sums. Now, private equity has its fair share of controversy. Critics argue that private equity funds often prioritize short-term profits over long-term sustainability, potentially leading to job losses and over-leveraged companies. Now, defenders counter that private equity is crucial in revitalizing struggling businesses and driving economic growth. The reality, as usual, is probably somewhere in the middle. While there have certainly been cases of private equity investments gone wrong, there are also numerous examples of private equity funds turning around struggling companies or providing the capital and expertise needed for good businesses to become great. A few real-world examples of successful private equity investments include Hilton Hotels. Blackstone acquired Hilton in 2007 for $26 billion. They expanded the company aggressively, improved its operations, and took it public again in 2013. By the time Blackstone fully exited in 2018, it had made $14 billion on the deal, one of the most profitable private equity investments ever. Beats Electronics. In 2014, the Carlyle Group invested $500 million in Beats. Just 9 months later, Apple acquired Beats for $3 billion, netting Carlyle a $1 billion profit. Airbnb. Now, not a traditional private equity investment, private equity-style growth funds played a crucial role in Airbnb's expansion. In 2016, TPG and Temasek invested $1 billion in Airbnb, helping fuel its rapid growth. Now, these success stories highlight the potential of private equity to generate substantial returns. However, it's important to note that not all private equity investments work out this well. The industry has its share of failures too. So who can invest in private equity funds? Traditionally, private equity funds have been the playground of institutional investors and the ultra-wealthy. Most funds have high minimum investments, often $5 million or more, and are limited to accredited investors. However, the industry is gradually opening up to a broader range of investors. Some firms now offer funds with lower minimums, and there are publicly traded private equity firms that anyone can invest in. A growing number of private equity-like mutual funds and ETFs also aim to mimic private equity strategies in a more accessible format. Looking to the future, private equity faces both opportunities and challenges. With interest rates low and many investors seeking higher returns, there's a lot of capital flowing into the private equity world. The industry is also expanding into new areas like technology and healthcare. The influx of capital means more competition for deals, potentially driving up prices and reducing the returns. There's also increasing regulatory scrutiny and pressure for greater transparencies. As we've seen, private equity funds are a powerful and complex force in the business world. They have the potential to generate substantial returns, revitalize companies, and drive innovation. However, they also come with risks and have been criticized for some of their methods. Whether you're considering investing in private equity, your company is a potential private equity target, or you're simply trying to understand the forces shaping our economy, understanding how private equity works is increasingly important. We covered a lot of ground here today, and I want to hear from you. What's your take on private equity? Do you see it as a positive economic force, or are you concerned about its impacts? Let us know in the comments below. If you found this video helpful, please give it a thumbs up, subscribe to our channel for more in-depth looks at the world of finance and investing, and don't forget to hit that notification bell so you never miss an upload. Until next time, keep learning and happy investing.